Time frames refers to the period that a trader would choose to operate in. There are plenty of time frames to choose from. Okay, it ranges from, like, TradingView even offers 1 second time frames, but the common ones are from 1 minute up until 1 month. So you get 1 minute, 5 minute, 10 minute, 15 minute, 30 minute, 1 hour, 2 hour, 4 hour, daily, weekly, monthly. Okay, so there's many time frames to choose from. Now, a bigger time frame would give more opportunity to gain profits, but also losses alike, right? Because it's such a big time frame. Also, prices are also more accurate on higher time frames. So, like market patterns, it's more accurate on higher time frames. Trend lines more accurate on higher time frames. Support and resistance more accurate on higher time frames. So, larger time frames are better. The type of time frame you choose will now determine what type of trading style you use and what type of trader you are. The advanced traders will use multiple time frames, so they won't just use one time frame, right? They will have 2 or 3, maybe sometimes even 4 time frames, to read the charts and now develop, a powerful strategy. So the time frame you pick will determine the length of the candle. So a 1 minute time frame, one candle will represent 1 minute of price. Okay, within that minute, price will fluctuate. That candle will fluctuate. So multiple time frame analysis. This is the process of looking at the same pair and the same price, but on multiple time frames. What are the benefits of looking at multiple time frames? Number one, they give you a different perspective and view of a currency pair, short term, medium term, and long term. Number two, help spot trend changes early, right? Number three, help you to enter or exit a trade as early as possible. Number four, help to confirm the trend change in a higher time frame. Number five, allow you to know what other market participants are thinking. And then number six, enables you to see the small picture, medium picture, and large picture. So here are the different types. So as you can see, that's Euro USD on the 4-hour time frame. That's Euro USD on the 1-hour time frame. And then that's Euro USD on the 15 minutes. So can you see, the higher the time frame, the more clear price is overall. Okay, so on the 4-hour, that might be a span of, let's say, a year, whereas on the 1-hour, that will be a span of, let's say, I don't know, I'm just guessing here, a few days. And then that span on 15 minutes would be a few hours, for example. So time frame, so the long-term time frame, okay, this refers to the daily time frame, weekly time frame, and monthly time frame. Those are the long-term time frames. Now, what are the advantages of using long-term time frames? You don't have to watch the markets every minute, and fewer trades mean you don't have to pay a lot of spread. Because the higher time frames, the less you will be trading. Disadvantages of using the daily, weekly, and monthly is not many trades placed, so patience is required. Bigger account is needed for long-term trades, because remember, you can be in a drawdown of more money because it's long-term. Short-term, okay, this is hourly. Hourly time frame trades take up hours to days. Advantages: more trade opportunities available. Don't need to rely on few trades to make money. Disadvantage: spread will cost more because of more trades, because you're going to be trading multiple trades, therefore more spread needs to be paid, and then overnight risk becomes a factor. Intraday, okay, this is the minute time frames, 1 minute, 5 minutes, 15 minutes. Plenty of trading opportunities, okay? That's the advantage. However, the disadvantage is spread much higher than short term. Mentally, it is more difficult because of bias changes quickly. So it might look like it's going up, and then all of a sudden it will just drop down, okay? So that can also be an issue. The time frame you pick needs to suit your personality. This is why it is good to start on a demo account so that you can get used to the time frame and see what time frame you prefer. Also look at your capital. That is also another important factor. Shorter time frames allow you to make better use of margin and have tighter stop losses. Bigger time frames require bigger stop losses, therefore a bigger account, so you can handle the market swings without facing a margin call. However, in the paid course, I show you how to do multiple analysis when, dropping down your time frame to just, having a tighter stop loss, even though we use like the 4-hour and the daily time frames. Why you need to look at multiple time frames. Okay, here's an example of GBP USD. So the first example is looking at the 10-minute time frame. So if we were to analyze this, okay, we can see that price is resisting, okay, to break above that, that simple moving average, that sort of line there, the blue line. Okay, so once it's rejecting, it looks like it could be a potential sell on a 10-minute time frame. So look what happened a couple of minutes later, or a couple of hours, should I say, later. Price went up, carried on, right? Look what happens if you've seen it on the 1-hour time frame. If you went on the 1-hour time frame, you would see it was actually a buy, because you would put your trend lines and look at the price over there. It increased. Okay, it was a support on your trend line. So you would most likely buy on that trend line. Okay, this is an ascending trend channel. If you move to the 4-hour, even more stronger sort of confirmation. Okay. So after using the demo account, you should know which currency pairs you like. So you have, remember, not many, okay, maximum of 3 or 4 pairs that you need to look at as a beginner. And then what time frames you prefer. Do you prefer short term, medium term, or long term? Or, a bit of everything. So let's say one of your pairs that you're choosing to focus on is Euro USD, and you like the 15-minute time frame, you like the 1-hour time frame, and you like the 4-hour time frame. Okay, multiple time frames. That's decent. 3 time frames is more than enough. Okay, so you need to do what's something called a top-down analysis. So you start from the highest time frame and you break it down all the way to the lowest time frame. So because you like the 15-minute, the 1-hour, and the 4-hour, you will start on the 4-hour time frame. Then you'll analyze on the 4-hour time frame. You'll then drop down to the 1-hour. After you've dropped down to the 1-hour, you'll then finally drop down to the 15-minute. All right. So here's an example of how to perform the multiple time frame analysis. So we start on the 4-hour time frame. Okay, you see a clear uptrend because you put in your ascending trend line. You can see it's making higher highs and higher lows. Okay, now remember, we need extra confirmation. So on the 4-hour, it looks good. It looks like a buy. Let's drop down to the 1-hour. You drop down to the 1-hour. Okay, you see that there's a candlestick, rejecting your trend line. And then you also spot a candlestick confirmation, which is the doji candlestick pattern. If you don't remember what a doji is, go back to the candlestick video. And your stochastic indicator shows a crossover. So that is about 3 confirmations on your 1-hour time frame. That also shows a buy. So on the 4-hour, you got your trend line that shows, and your market structure that shows Euro USD is a buy. You drop down to the 1-hour, and you got your trend line, you got your candlestick pattern, and you got your indicator, your stochastic indicator, showing that is also a buy. Now, to dissect it even further, to look for a good entry point, your stop loss, and your take profit, you drop down to the 15-minute time frame. Okay, on the 15-minute time frame, you can see there's 1, 2, 3, 4, 5, about 6 candlesticks that is rejecting your trend line. Okay, as well as your stochastic showing oversold, meaning there's a buy about to happen. So now on all three sort of time frames, it shows that Euro USD is a buy. So you open a buy position. As you can see, there's your entry area. Uptrend continued, price carried on, and you were in profits. So use multiple time frames between 2 or 3. 4 is pushing it, but you can still trade 4. Please, just not 1, okay? Because you just can't, like I said, you can't just base it off of 1, because on the, let's say, the 10-minute time frame, it looks like a buy, but overall it's actually a sell. So you need that multiple time frame, and then if you use more than 3 or 4, then it's just going to confuse you.